Welcome to the TEK2day podcast powered by CEO Radar. It's your host, John Mayetta. Quality companies outperform over the long term. It's the title of a TEK2day article we published earlier this morning. And as I say in the article, management teams matter. And we talk about how certain quality companies may not be the sexiest and therefore may have underperformed during this bubble period of the past 15 months versus, the hype companies like Tesla, as an example, or the super growth companies that are burning through cash but have accelerated revenue growth. The high beta bets. But if you look at quality companies, and we provide some examples in the article, they tend to outperform in normal times. They tend to outperform in a market that's a down market, and they tend to outperform over an extended period of time. And it's because the management teams, they don't chase hype. They try to build and market products, whether it's a software application or a technology-enabled service. They try to invest in products that deliver real customer value. They're in it for the long term. They take the long view, the ultra-long view. Like Amazon takes a 50-year time horizon as an example. They don't chase hype deals. So, for example, it's been interesting to watch the amount of M&A activity that has taken place at these outrageous valuations. I mean, even if you're paying for the deal with stock, you're still diluting your existing shareholders. I, for one, would pass, even if this bubble lasts another year. I don't know exactly when the Fed's going to increase rates, whether it be tapering or the Fed funds rate. Ultimately, they'll do both. We're not going to see rates go back to where they were when I was a high-yield investor because we simply can't afford it given the amount of debt that's out there. So maybe they go to 2% over time. But there will be some sort of an increase. Valuations will fall back. And that would be a better time to execute M&A. So I would just literally put the M&A activity on pause. The other element I expect to fully happen, and I expect to see it in our business on the fintech side with our CEO Radar platform, is as the equity markets pull back, you're going to see investors become increasingly interested in who are the people that comprise the management teams of the companies that they own in the portfolio. So management teams are going to matter more to investors who haven't given management teams a second thought during the bubble, who have just been ultra focused on macro and interest rates and so forth. And I think this next period, when we have this down market, I think it's going to be an extended down market. I don't think it's going to be something that rebounds quickly because the Fed just can't keep throwing capital at the market. We can't take debt to GDP, debt at 500, 600% of GDP. We already look like Japan. So I think you're going to have a prolonged down market. It's going to look a lot like 2009. And that was the last time, 2009 through, I'd say 2012, 2013, but 2009, 2010 at that trough. That was back at the time when I was an equity research analyst on the sell side. And I remember most of the conversations I had with investors was around, John, who are the best CEOs that you follow? Investors wanted to spend more time on understanding quality management team because they needed something to hang their hat on. Right? All stocks, and I'm talking about, I was covering fintech, tech-enabled services, IT services, maybe a bit of application software, and all valuations were down significantly. I don't know off the top of my head. I can't remember what the average decline in market value was for my coverage list. Some of the services guys lost more than 50%. Some of the software guys are down 30, 40%. And so therefore, companies weren't sure when revenue, institutional investors weren't sure when revenue growth was going to return, when profitability was going to return, or much less when valuations would snap back. Everything looked cheap. Well, on the software side, things looked cheap. On the services side, some of the profitability, fell off a cliff. So it wasn't like PE multiples got 80% cheaper because the E got a lot lower on the services side. But on the software side, stuff got cheap because valuations came way back in, but revenue and EBITDA and cash flow didn't take a commensurate drop with market cap. Right, so some of those names got really cheap. But in addition to those names being cheap, investors want to know, well, which one do I pick? Right, because a lot of these institutional investors don't have the time to understand companies at a nuanced level, understand what's going on from a competitive standpoint at a nuanced level, certainly don't have time to understand product and services at a nuanced level. But one of the higher level themes they could really hang their hat on was quality of the management team. And so we spent a lot of time discussing that specific topic. And I think 2021, end of this year, 2022, market pulls back and investors are going to spend more time digging into management teams, and that the management team variable will take on a greater share of the amount of time that institutional investors invest in their due diligence process. Right, they're really going to assign more weight to whom management teams are. And so that means I'm probably going to spend more time writing about these issues and talking about these issues on the podcast. And we'll be out there when I'm not engaging on an advisory assignment or consulting assignment. We'll be working to raise money so that we can codify some of the intellectual property that we've created over the past few years and build it into our CEO Rater platform. So that when this market does roll back, we'll have some stuff that's built into the platform, self-service, that investors will be able to navigate themselves. So productize more of our offering rather than have it be a pure or almost a pure service, which it is at the moment. That's all for now. See you next time.